Hello, everyone, and thank you for joining today's panel call from ITI Mutual Fund. My name is Mayuk Datta, and I represent ITI Mutual Fund today, and I shall be the moderator for today's call. Today, we have an interesting topic to talk about. As the Nifty and the equity markets are at lifetime highs, and while fund managers were being cautious for the calendar year 24, markets have been having its own path to walk and surprises everybody on a daily basis. While markets are doing on an all-time high, and for today's discussion, we will try to concentrate on everybody's favorite part of the market, which is mid caps, and how they have been rallying for quite some time, and whether this should cause a wall of worry for investors, or is this a start of a new structural upside? To discuss about all of this today, I am joined today by two esteemed panelists. We have Mr. Mrunmay Das of Das Capital from Bangalore and Mr. Rohan Kode, fund manager from ITI Mutual Fund. To introduce them further, Mr. Mrunmay Das is the founder director of Das Capital based out of Bangalore. He has a very rich experience of more than 2 decades in investments landscape. He has been an ex-CIO of Azim Premji Investments. He has worked with international names like Merrill Lynch, BNP Paribas, and UTI in his earlier stints. And he started his own firm, Das Capital, about more than 15 years back, and has since then been into investment for HNIs and ultra HNIs. And he has a rich experience of understanding market cycles and also investor psyche during these market cycles. Mr. Rohan Korde, fund manager from ITI Mutual Fund. He has been with the AMC since 2019. He has a degree in Masters in Finance from Mumbai University, and has a Bachelor of Commerce degree from R.A. Poddar College in Mumbai. So thank you both of you for joining for today's call. I would start with Rohan with your understanding. If you could give the audience an understanding of where markets are currently, the way markets have been rallying or going up. It also causes an area of concern for investors, very surprisingly. And they always have a fear that if it is at such highs, what is in store for investors for 2024?
Right. Thank you, Mayuk. Hello, everyone. So I think let's look at what the markets have done in the past 1 year. Nifty has gone up by 20% in the calendar year 23. Large cap stocks have, the large cap index has gone up by 23%. The mid cap index has gone up by 58%. And the small cap index has gone up by 69%. So clearly, while Nifty has given good returns, it's the smaller and mid cap stocks which have given a better return. Similarly, even if we take the 5-year average, then mid caps have outperformed large caps by 86% and small caps have outperformed by nearly 60%. So that is the kind of performance we have seen happening. Now, is this performance being driven in isolation? I don't think so. This is being supported by good growth. Even for the past 3 quarters, if we see, the GDP growth has been in excess of 8%, which is a very strong GDP growth number that we have seen. If we take just the near term, where people are maybe getting worried because of the rally we have seen in the market, then most of the major economies, even in January 24, ended lower on a month-on-month basis. So barring Japan, Russia, US, I think other key global markets like China, Korea, Brazil, UK, Indonesia, Taiwan, all of them closed lower on local currency terms. And India's strong growth has meant that over the last 12 months, the MSCI India index has also outperformed the MSCI Emerging Markets Index. The MSCI India index was up 28%, while the Emerging Market Index was down 5%. So coming back to the entire point that this is not being driven in isolation, it is the growth which is propelling the kind of rally in the market which we are seeing, which is captured also by the GDP growth, which is captured by the GST collections, which is captured by the corporate earnings as well. Corporate earnings and corporate profitability growth has been on the stronger side as well in the last couple of years, where each year is giving us a better and better performance. Now, we cannot say that it's not exact. Everything is hunky-dory. We need to keep an eye out whether there can be any event which can maybe bring down the markets or which can cause a correction. But we feel that the market has navigated issues such as the geopolitical issues such as conflict between Russia and Ukraine, also the entire Red Sea crisis. I think all of these have been negotiated to some extent. Some not all of them have been resolved, but we have been able to see that it's been managed. The issues are being managed through either through government action or through workarounds being found. So all of these has resulted in a positive traction continuing. So we have a bullish macro environment. We had no populism agenda in the interim budget. We have resilient corporate profitability in YTD FY24, and the outlook of the next 2 years is also good. So despite the concerns such as the geopolitical crisis, the weak underlying consumption in the economy, especially on the rural side, and the relatively higher valuations, I think there is adequate scope where the positives outweigh the negatives. A word on the valuations at this point of time here as well. On a 1 year basis, probably the Nifty is trading at around 20x, which is a slight premium to the past 10-year average. Uh, but that is not really a reason for a sell-off, right? The growth has been so robust that the valuation should not just be at the trailing average, but it can potentially be at a premium as well for the flagship index that we have. So from that perspective, I think we need not get too concerned. Interim corrections will keep on happening, reacting to events or reacting to certain macro, micro, or overseas events. But on a general basis, I think we are in for a good medium term to long term performance by the Indian economy, which will eventually get by the broader markets as well.
Sure. Thank you, Rohan, for setting up the context on the mid caps. My next question is to Mr. Das. Sir, what do you think MFDs or people should be considering while they are pitching or mid cap funds to their investors, or they are considering such schemes for themselves?
Hi, everyone. When we are talking about mid cap, two risk factor comes to my mind. Large cap versus mid cap. Why should one go to mid cap? Number one is liquidity. Ron will agree with me. Number two is the quality of data or information that we get. How reliable or what is the validity of that data? These are the two key risks we look at when we are looking at mid cap. Now, still, why we do mid cap? Again, Rohan described it nicely that the outperformance, or in our language, the alpha.
Sure.
So these two risks and this one reason will be the underlying assumption for me as we go through this call totally, because these are the basis on which I will base my position in this discussion. So if you look at now, you're asking me the question that what an MFD should do as far as investor psyche is concerned. Ideally, an MFD should not be recommending a particular product or class of products on a standalone basis. Allocation to any fund should be part of an overall portfolio plan. This holistic plan will address investor angst to a large extent. Apart from this, if you still really want to recommend such funds, then keep in mind loss aversion, which is a very common trait whether you are pitching mid cap to an HNI or a retail. An investor may not be happy when funds go up, when NAVs go up, like currently how it is going up, but he becomes really miserable during corrections. So ideal situation would be having an exposure of not more than 15 to 20% to mid cap in the overall portfolio. Then you can not only manage portfolio volatility, but also you can take care of the alpha that you are targeting in the long term.
Great. So bringing in loss aversion as a method to actually maintain alpha, that's a very different way of approaching mid-cap investments. So thank you for that. Rohan, my next question is to you. How closely do you track momentum, and how large a part does it play in your sector selection process? Do you actively track and follow sector rotation as it plays out, or would you have a different strategy?
I think when we invest in mid caps, we should have a more longer term view in play. It is difficult to follow sector rotation or momentum if you are invested in mid and small cap stocks, because as Mr. Das also said, the liquidity angle is quite important over here. So we prefer to take longer term calls. We do not pursue momentum as fundamentals, valuation, earnings growth. All these are more important factors. the long-term theme which is running, whether the fundamental story will last for a longer period of time, or is it a very ephemeral kind of a story? I think that needs to be considered when investing in a mid cap or a small cap stock. Whether a small cap stock has the potential to become a mid cap and eventually a large cap over a period of time, I think that is what we need to evaluate. We need to evaluate the vision of the promoters, the sector that particular company is in, how strong is the balance sheet, whether it's a turnaround story or whether it's a long-term secular growth kind of a story. I think these are more important factors to be considered rather than taking short-term calls like momentum or playing out sector rotation. Eventually, what happens is that while returns can be made by these strategies also, uh, the returns can potentially be suboptimal because impact cost will be there, and the possibility is that the longer term story then tends to get missed out in tracking momentum. So we prefer to stay invested, if possible, as much as possible in the mid and small cap stocks and take longer term calls.
Great. So, Mr. Das, my next question is to you. Most of the time, selection of a scheme is possibly looking at past performance. But when you look at mid-cap schemes in the universe, how do you assess them and choose one over the other before it is put forward to clients?
Yeah, good question. Actually, we face this on a regular basis. See,
Yes.
basically, 5 or 6 criteria will come into play when you are choosing a particular scheme over other. First is good portfolio quality. Number two is overweight exposure to sectors which are likely to do well, where macro tailwinds are there. Third, fund manager track record. Fourth, how well diversified the portfolio is towards risk mitigation.
That,
And a key criteria which we look at, which is the fifth point I want to bring across, is a large part of the scheme's history from inception. It should have remained at least in the top two quartiles. We understand that every fund has a bad phase, but at least top two quartiles from the history of the fund. And last but not the least, which Rohan also touched upon, portfolio consistency. You know, as in the fund manager takes a long-term bets on stocks and sticks to them, doesn't churn regularly, because that gives us a lack of direction in that case. So these are the 5 or 6 criteria. If the scheme is maintaining, we are good to go to the families that we look at and continue to stay invested in a particular scheme.
so lovely. I think none of those actually talked about just looking at performance, except for the quartile was more important than looking at performance. So really appreciate that, how you have assessed it and broken it up without looking at just past returns, which most people do. Rohan, my next question is to you, and this is with regard to the fund which you manage, which recently completed 3 years, which is the ITI Mid Cap Fund, and it has been consistently been on the top of the league table. With the concerns which recently have been going on regarding mid and small cap valuations, how do you propose to navigate the mid cap space and maintain your fund's current stance, and what is the view forward on that?
I think in terms of valuation, as I mentioned in my initial answer as well, that mid cap index is probably Nifty is at the premium, not at a premium, a slight premium only, but mid cap index is trading at
Okay.
one time standard deviation of more than 30% premium to the historical average. So there are reasons for this. It is also a fact that many of the stocks which form part of the mid cap index are companies which have been doing exceedingly well over the years, and that's why they have moved up from the small cap category to the mid cap category. So typically, their earnings trajectory is on a high growth path. The potential of their earnings is yet to be fully captured in the estimates. It can get captured only with a lag effect. The other factor is that uh, it's also a niche kind of a market that many of these companies are operating in. So when you're operating in that kind of a market, then there is no precedent for the index to have those kind of companies in it. So initially, if there were a certain category of companies trading at a certain valuation, the companies which then form part of the index over a period of time due to the high growth phase, they typically might be belonging to some other industry which has a higher valuation multiple. At the index level, it appears as if the index is now expensive as compared to the past. But in reality, the profile of the constituents of the index have changed, which mean that the past parameter was not as relevant as simply because of the change in constituents. But having said that, of course, we also need to make sure that our downside is also protected while participating in the index performance and trying to generate alpha for investors. We also need to ensure that we do not become reckless. And for that purpose, we have a diversified portfolio. We prefer not to take a very high weight in any particular stock, no matter what the confidence level in terms of the company's performance might be. We make sure that the risk weight is appropriate and is followed on a consistent basis over a period of time. We also have a balanced exposure even in the mid cap fund. By definition, we are supposed to have 65% investments in mid cap stocks as defined by AMFI. We take a balanced exposure where 70% is invested in mid caps, 15% in small caps, and 15% is large caps and cash. So this gives us downside protection as well by having close to 15% of large caps and cash in the portfolio, as well as generate alpha through the mid cap portfolio that we have, and partial exposure to small caps, which we believe have the potential to become mid caps in the future. So we are an early entrant into the stocks and capture the the performance of the stocks from a very early stage, and then reap the benefits of long-term investing. We believe that opportunities exist even at current valuations, even at the current stage of the market. There are bottom-up opportunities that can be found due to by doing good research, and we can still get into quality stocks even at these levels. And that is our entire endeavor to make sure that we stay invested in quality companies. We find new quality companies which can deliver outperformance as compared to the benchmark, generate good alpha for investors, and that is what the bottom-up research is expected to drive. We'll also stay invested in themes that we believe will do well from a medium to longer term, which can be structural stories going forward, and that will also help us navigate what can be potentially be banana skins that the market might throw up in the future. And lastly, while we believe in long-term investing, we also believe that we should be nimble. If we feel that any company is not delivering performance as per what the market is expecting, then let us not be belligerent. Let us be nimble, and let us get into idea which we feel is more likely to deliver good alpha for our investors. So constant monitoring of the portfolio is always the case to make sure that corporate performance is as per our expectations, and there are no negative surprises that come up.
Sure. Thank you, Rohan, for that. So, Mr. Das, my question is, while the fund manager is managing the scheme by his understanding, what is your investment strategy when it comes to mid-cap investing? What route do you recommend to your clients through SIPs, STPs, or lump sums? What is your strategy currently?
See, if you look at my overall strategy is not to be more than 15 to 20% in mid-cap of my portfolio.
Sure.
So therefore, within that next 3 years, the visibility is very good, and as what Rohan told, the outlook is also very strong. We are doing lump sum and advising client to go lump sum for the next 2 to 3 years, and that too while maintaining my overall exposure not to exceed the limit that I have already discussed. SIPs to mid caps are a great idea, but as long as the SIP tenor starts with 60 months minimum, because otherwise someone like Rohan will not like to have that money which is not staying in the fund for long. See, ideally what he would like is, while he is managing an open-ended fund, he would like to have a closed-ended fund. That is, entry exit puts him off the rail because of my first two risk criteria which I described, mainly liquidity. Impact cost can throw him off from the radar where he is targeting to enter for a particular stock. And hence, SIP is good, but 60 months is the minimum tenor that we look at to even look at a SIP into mid cap.
Sure. Thank you. Rohan, my question for you is, which sectors are you currently underweight and overweight in your mid-cap fund, and what's your rationale for the same?
So at this point of time, we have a sizable overweight in the cap good sector. And the main reason for this is that there are a lot of conviction long-term bets that we can take in this sector. If we look at the India story, it is going to be driven by Atmanirbhar Bharat, investments driven by schemes like PLI. Uh, it will be driven by import substitution, export promotion. So manufacturing of uh, goods, including capital goods, I think that is going to be a sector which can deliver good returns over the longer period of time. At this point of time, we have seen a lot of public sector capex happening. Expectation is that over the next couple of years, as capacity utilization in the private sector also gets to a peak level, we'll start seeing incremental private sector capex coming in, uh, preferably coinciding with the time that the public sector capex maybe starts to slow down, but they can potentially be overlap between the two as well. So the entire cap good space, and over here we can include infrastructure, real estate as well, even something like EMS or auto ancillary, the entire manufacturing space. I think this is a sector which will do well over the longer term, and that's why we have kept an overweight position in these sectors. The other sector that we also like is the entire power generation theme. As we move towards more of renewables and move towards net zero by 2070, I think the green energy and renewable theme will play out incrementally well. At the same time, we also are likely to see some shortages on the existing generation capacity. So even thermal might be in vogue for from the medium term perspective. So we are trying to balance it out with having investments in both kind of emerging technologies for energy as well as the existing power generation capabilities as well. So these are the two sides where we are extremely positive on. As far as underweights are concerned, we have an underweight position in the pharma sector at this point of time. We have preferred to invest in quality stocks which have a long-term potential in the pharma space. We believe that the pharma story is incrementally turning around. So the underweight position at this point of time is more driven by the fact that we see more positivity on the cap good side, and that needs to be balanced by underweight position in some other sector. But incrementally, I think the story around the pharma space is getting more and more positive as more and more product approvals start coming in, more and more molecules start getting approval as export opportunities keep on opening up. I think the pharma story will turn for the better in the medium term. The second underweight sector we have is on the IT side, where we don't want to take a preemptive call on interest rate reduction. We will wait it out. We'll make sure that the slowdown in US is over, and IT budgets start increasing before we take a fundamental view to move overweight on the IT sector. Till that time, we have done bottom-up research, and we are invested in some quality mid-cap IT names, but as a fund house on an overall level, we are underweight IT as compared to the index.
Okay, great. So my last question is to both of you, and I'll start with Mr. Das for it. What are your views? Is it a good time to take some profits off the table from, especially from sectors which have run up, and put the money into places which have yet to benefit? Would you be looking at this rotation investment strategy, or would you be in the other camp of staying put for the long term? So, Mr. Das, let's start with you, and then Rohan can answer that.
No, actually, this question is purely for the fund manager. It is prerogative of his to choose sector, to move in, to move out of a particular stock in that sector. As investors, see, who am I? I am basically representing investors. As investors, we should focus on long-term money and give stability to someone like Rohan. And basically, if you look at from an investor point of view, he is not equipped to time the market. He is not equipped to do this at all. So it is expecting too
Sure.
much. So I won't do that. Second thing is, if portfolio level anything practical he wants to do, then that is again purely Rohan's call, not mine. So profit booking or taking money off the table, I have never done. If you know, in the market, Das Capital is known to be a sticky, provider. We have not redeemed much. People give AMCs like us because of that factor that we don't come out at all. It is sometimes to their inconvenience that we don't come out, maybe, but we stay put. Only event
Sure.
where I need liquidity is if the investor has driven a liquidity event, which I am
Sure.
not able to plan any other way from the non-equity allocation, or he is not able to plan from his other assets, is the only time I come with a redemption with a reluctance.
Sure,
Otherwise, we are known to choose right, sit tight, leave it to Rohan to perform.
sure. Rohan, your call on the portfolio side.
My call is that if any sector is doing well or companies in any particular sector are doing well, till the time we feel that it has been milked for all the growth possible, all the then that is on the revenue side as well as on the profitability side. I think we should write the entire story. Let us not take preemptive calls that we need to exit a sector just because it has run up. Uh, we need to balance it out, of course, with valuations, but growth balanced out with valuations, balanced out with liquidity, which is also a very important criteria as far as stock movement is concerned and re-rating of valuations is concerned. I think we need to balance it out in all three parameters. And if then after looking at all parameters together, if there is any signal that the best is behind and it is either in a phase of going to be in a phase of stagnation or potential valuation correction, then we can exit that particular stock or that particular sector. There can of course be some tactical ups and downs, or there can be some other sector which has more upside as opposed to the sector we are overweight in. That is also another consideration. If some other sector becomes more attractive, then it's a balancing act that we need to move to some other sector which can potentially deliver better medium term returns and book some profits. So it is a dynamic kind of a scenario, and it cannot be looked at in isolation. But bottom line is that booking profits simply because something has gone up, exiting a stock completely or sector completely. I think let's not get that judgmental and that short-sighted, because in the end, it may end up harming our return generation capability more than anything else.
Sure.
So
So
if
thank
the
you both.
fund manager is sorry, if the fund manager is looking long term, where is the question of we guys, having any myopic view compared to his? So that will be unfair to someone like him who is managing. Sorry to cut in, sir.
Absolutely. No, no, absolutely right, Mr. Das. That is exactly the point I wanted to bring out, that there is so much of discussion about profit booking, and you had beautifully put it out that profit booking is only need based. If you need the money, and as Rohan talked about, if the opportunity is over or there is a better opportunity. So both are need based if only people are able to see it and not because of external. A need is all of our own needs and not necessarily what the market is indicating.
Now, mine is
So
not even a profit booking. Mine is a liquidity event, not profit booking
absolutely.
at all. That is his job. He should book profit and keep me at a level where profits are still there in the scheme, not in the pocket. That's all. If he wants, he can go cash. I need not know, but not profit booking at all. I am not a profit booking guy at all. I want to repeat and reiterate my position very clearly.
No, no, absolutely. So appreciate that you to give a very distinct side, that rather than giving a either side of the net answer, this was exactly what we were looking for. So thank you so much, Mr. Das. Really appreciate that you took out time and were so coherent and cogent about your views. Thank you, Rohan, for taking out time to be part of the panel. And thank you, viewers, for being a part of this session from ITI Mutual Fund. And we look forward to bring such sessions again. Thank you to both of you for being so generous with your views, and we will come back again with more such sessions in the future. Thank you and take care.
Thank you, Rohan. All the best. Bye.
Yeah, thank you, Munmay sir. It was really wonderful.